It is important to understand that the Fed's interest rate manipulations are intended to influence the behavior of borrowers, not investors, and the Fed chair agrees. In his most recent press conference, Powell reiterated that the Fed funds rate continues to be the Fed's primary tool to influence the U.S. economy. Based on the Fed's analytical framework, the economy is slowed by a series of interest rate increases because the behavior of borrowers is constrained. Using similar logic, the economy is stimulated by a series of interest rate declines because borrowers use the reduction in interest expense for other purposes that promote economic growth. But the Fed also bought $3.6 trillion of governmental obligations during the quantitative easing experiment in the belief that quantitative easing would also boost the U.S. economy. Unlike interest rate manipulations, quantitative easing is direct manipulation of bond prices and yields and is clearly directed at investors, not borrowers. This key difference between who quantitative easing and quantitative tapering targets are incredibly important and not often fully understood. So since November 2017, the Fed has embarked on quantitative tightening, a policy that forces investors to refinance trillions of U.S. government obligations that are maturing from the Fed's portfolio. So here's a question. Can the movement of asset prices during the quantitative easing period give clues about how asset prices might move during quantitative tapering? Let's take a look. So the intent of this video is to show that the Fed's quantitative easing policy produced the counterintuitive result of higher yields on Treasury bonds, not lower yields as applied by so-called supply-demand analysis. Using a symmetrical logic, the Fed's quantitative tapering policy should be expected to reverse the effects of quantitative easing and to produce the counterintuitive results of lower yields, not higher yields, again implied by the supply-demand analysis. So looking at this chart here, quantitative easing was launched back in 2008 and ended in late 2014 after 3 rounds of purchases plus Operation Twist, which extended the duration of their holdings. The following chart here shows that the S&P 500 rose 176% during the periods in which quantitative easing was operative. And you can see there in the colored lines, you're going to have to strain. Now, all of that happened while the S&P 500 declined 32% during the non-quantitative easing periods in the gray. So let me show you those in the gray. This is the gray here, right here, right here, and then lastly up here. So those are the periods where you need to pay attention. And so again, the S&P declined 32% during the non-quantitative easing periods, those in the gray. Since mid-2015, when this chart was created, the S&P 500 has risen from about 2,100 to over 2,700, a gain of 31% that offset almost all of that 32% loss. So clearly, quantitative easing produced an upward bias to stock prices. Now, taking a look at the chart there, you're going to wonder why that top portion where we are today didn't decline. But we need to point out that many other central banks, such as the Bank of England, the Swiss, the Japanese, whomever, continued buying assets after the U.S. quantitative easing program ended, and then they continued their own quantitative easing programs, which played an active role, say directly or indirectly, in supporting the S&P 500. So let's go to the next chart. So again, the last chart was the S&P 500. And so now we move to this chart here, which is the U.S. Treasury, the 10-year yield. So with regard to the Treasury bonds, quantitative easing produced a different result that many didn't expect. The 10-year Treasury yield rose 184 basis points during the periods of quantitative easing and fell by 293 basis points during non-quantitative easing periods. And again, those non-quantitative easing periods here are in gray, and they correspond with the chart that we just looked at. So this is period 1, period 2, period 3, and then the current period right here. So you got to ask the question, why did this happen? And it appears that despite the bond purchases by the Fed, sales by other investors overwhelmed the Fed's action. So now since mid-2015, the 10-year Treasury yields have risen from 2.25% to 2.85%, offsetting some of the decline in yields that occurred during the non-quantitative easing period since 2008. And so again, even though we have a non-quantitative easing period right now, the rise in the rate is due primarily to the continuation of the quantitative easing programs by, say, the Bank of England, the Bank of Japan, the Swiss, and maybe even the Chinese. So let's go to the next chart. And another surprising reason that yields might have risen during quantitative easing and fell during non-quantitative easing, while the Fed was buying trillions of dollars of bonds, is shown by this chart here. And you can see that inflation expectations rose by a total of about 274 basis points during periods of quantitative easing and fell by about 104 basis points during non-quantitative easing periods. Therefore, the markets apparently believed that quantitative easing would produce inflation. So let's summarize here. The results of the stock and the bond markets post-2008 during quantitative easing periods, the Fed bought $3.6 trillion of governmental obligations, but the bond yields rose. But during non-quantitative easing periods, the bond yields fell, and almost nobody expected this, yet that's exactly what happened. And this last chart here, which you've seen many times before, this is the monthly chart on the 10-year Treasury, and the symbol is TNX. And as you can see here in the far right, we're approaching the 10-year yield again of about 3.0. Currently, we're at 29.75. That was the close today. So we're approaching that 3.0%, and we'll probably breach that as we did earlier this year. And again, my expectation is that we're going to reflect back down, because that 3.0 yield on the 10-year Treasury, I believe, is going to cause some stress in the markets, the debt markets. There's a lot of debt, so that stress is being created right now. So my opinion, my humble opinion, is that the yield is going to rise here in the short term, but then going to get reflected back down, and I think that we're going to have probably a year or two of falling interest rates. So if you want to find out what happens, stay tuned and subscribe to this channel. For today, that's ChewDog Charts. Thank you.